Hello and welcome back to the ROI Podcast. He's back. The Unemployed Value Degen and I are going to raise our right hand and solemnly swear that we will not mention tariffs for at least 5 minutes into this podcast. Steve, how you going, mate?
Oh, very well, very well. It's warming up here fast though in Florida. We have like a 4-month period where you just don't want to go outside because it's too hot and humid.
Yeah, it's the heat I can handle. The humidity, I'm not such a fan. Anyway, we've had a boring, uninteresting week in markets. Not much has happened. We've had a huge amount of volatility. I regretted not buying those out of the core VIXs back a couple of months ago, as it happens. But c'est la vie, mate. The world seems to be fragmenting off, and what I want to do is start the conversation around specific companies, because that's what the people want to hear, apparently, that will do well inside a more fragmented domestic US market. Now, you educated me on the amount of wealth that's in the baby boomers generation, let's say, in the US, something maybe in the $75 trillion dollar range. That, to me, I stop and think to myself, is really, really interesting. Why am I going to go out into some of these smaller markets? That's a huge pool of capital. Those guys, generally speaking, are old. And you know what you need when you're old is a steady stream of income. And so someone like a Jackson Financial has really taken my fancy. You've done a wonderful piece on the company, really done a lot of work. The company to me looks felony cheap at, about half book is when I started really buying this thing. Let's recap the thesis around Jackson Financial, and then we'll get into the nitty gritties and see if we can risk proof this with what might go wrong with the company.
Yeah, so Jackson Financial is the market leading company in the US for selling variable annuities. And they're climbing the ranks. I think they doubled their market share over the last year for doing index linked annuities as well. So they're kind of the Cadillac of the annuity market. If interest rates stayed high enough long enough, then fixed annuities, they started coming back a tiny bit, but with interest rates falling, they're probably not going to come back for a long, long time. Annuities are a niche investment product for the most risk-averse investors. And there's not that many investors that are risk-averse enough to need to put a lot of money into an annuity. But oftentimes when you have a husband and wife and the husband passes away and the wife is left not really knowing what to do with the money and also being much more risk-averse than the husband, that's usually about the time that they'll need that guarantee from an insurance company that says, no matter what happens, the worst case is you're not going to lose money. You might not make a lot of money, but you're not going to lose money. Because those guarantees from an insurance company, they're expensive. So the annuity companies, they earn their assets under management from the assets that they've gathered. Jackson Financial has gathered, I think it's around $330 billion of assets, it's very big as far as annuities is concerned, but it's very small as compared to ETFs or things like that. But another thing about annuities is the customers are sticky. You almost never surrender an annuity because there's not a marketplace for it. If you want to surrender the annuity, you have to go to the annuity company and you have to just agree with whatever they offer you, which always comes with some sort of a pretty hefty penalty. So, and again, the very small number of people that an annuity is right for them, they were so risk averse in the first place, they generally don't even really want to surrender the annuity. So it's a very niche product. So Jackson Financial is the market leader in that product. They were a spinoff from Prudential. There is just some risk there. So they do have some guaranteed minimum payments that they've put into contracts. And but at the same time, they've typically set aside about 4 or 5 times the amount of the statutory requirement amount that they have to set aside for. So this is an extremely conservatively run company, but there is always the chance that they mismanage their book of hedges the wrong way, because to make sure they can guarantee that the client's assets are safe, they have to go out into the market and they have to buy stock market hedges and interest rate hedges and all sorts of things. So they're collecting these assets under management fees from the money they're taking care of. They spend a chunk of that money buying a huge book of hedges, and they pay themselves the rest of that assets under management fee. But it's
let's take a step back. They gather the assets. They have an annuity obligation. Then, what do they invest that capital in? Like a float from an insurance. Are they investing in bonds, credits? How do they get to this point? And then obviously they have to hedge the risk of whatever they invest in.
Yeah, so they do have, and you can see in their investor presentations, they've got their very conservative book of investments. A lot of it's in bonds. Well, with fixed rate annuities, it would all be nominally fixed, but with the index linked to the variable annuities, there's some sort of stock market like exposure, but it usually has a ceiling to it. So if the Nasdaq goes up 25%, your variable annuity has a best that you can possibly do that year. But at the same time, if the Nasdaq falls 20%, you have a floor underneath you. And this kind of product is very attractive. There are some ETFs that are mimicking this now. So the market is trying to fill this demand. I forget the ticker symbols for the ETFs that do this, but there are these risk managed ETFs. But again, you're paying for these derivatives over time, and they're not cheap.
I see. And so what do you think is, so we've got some duration risk and derivative risk, some complexity in the management, potentially new competition coming in. If an ETF product would essentially mimic what this company does, that would obviously be very attractive to people who are savvy enough to buy on the open market. But the people that you mentioned that are going to buy this, they strike me as the same type of people that are going to be going to their community bank to ask for a reverse mortgage type of crowd. So what kind of relationship does Jackson Financial have in terms of attracting this clientele? Do they have relationships with financial advisors, local community banks, that sort of thing?
Yeah, so the people that buy an annuity, they're not, reading Yahoo Finance and looking up information about individual stocks. These are people that there's a big division of knowledge in society, a big division of labor. They're not really savvy in finance. So I don't think the ETFs are really going to compete effectively with Jackson Financial, because the people that this investment's suitable for, they don't even know what an ETF is, most of them. And I'm not trying to be mean. From back when I was an academic, one of my peer-reviewed papers, we included in it some data from a survey. And if you were interviewing people from the baby boomer generation and you ask them, which typically has a higher rate of return over time, stocks or bonds, you get like half of them not knowing the answer to that. There's a lot of very, very basic knowledge about investing that about half of the public doesn't have and doesn't want to have. So I don't think ETFs are really a big competition for annuities. Jackson Financial sells their annuities through the financial advisor network. I mean, there's tens and tens of thousands of financial advisors across the country. Jackson Financial, because they used to be with Prudential, they're known to be a quality leader, right? So they answer the phone and you call them, they have good tech support, but they also pay the highest commissions. So that's there's an old Charlie Munger thing about, he's asking economists, in what situations could you raise the price and actually sell more units? And some people will talk about, there's this thing called a Geffen good, like Peloton did that with their exercise bike. But then Charlie Munger said, well, you just bribe the purchasing agent, because that's how the real world works. And in this case, that's the Jackson Financial way, is they are the quality leader. They also have a lot of bells and whistles. They have a lot of, a la carte customizability to their annuities, but they also pay the highest commission to the financial advisors. And that gives them the number one spot in market share for variable annuities. And they're climbing very, very quickly for index-linked annuities.
Yeah, I think this product's going to be very attractive in an environment where those with the capital are simply looking to assure their income needs are met into retirement before they pass away. Now, let's take a one-page overview, which can obviously be misleading, but I'm looking at some of the latest metrics on this company. As I mentioned, when I started buying, price to book was at half, which struck me as very, very strange. Next 12-month PE, analysts are estimating around 3.5, 3.6 times earnings that you're paying for this company, less than 7 times the cash flows. To me, for a company like this, that seems extremely cheap. Have there had any problems? Is there a reason why this company would be trading at such seemingly low valuations?
Well, sometimes I think it just takes time for the market to get used to something. And when and they've only been public for just 2 or 3 years now. When they first went public, the way that Prudential reimbursed themselves for the spinoff is they spun off half of the shares, kept half, and they sold into the market for the first year or so. So the stock price was really suppressed while Prudential was selling into the market. Now that's over. Prudential's shares are gone. They're no longer selling. And that's when the stock price went from like a rubber band from $40 to 120. I think it's going to take a lot of time. There's also a huge problem with, so after the global financial crisis in 2008, the mark-to-market consequences of derivatives are huge. So if you go back and look at their, GAAP accounting, and you look at their quarterly earnings, you'll have a $40 stock that has a quarter where they lose $60 a share, and then a quarter where they make $40 a share. And none of that is how the business is doing. It's how this massive book of derivative hedges on $330 billion of assets under management is performing if interest rates move 1% or the stock market crashes 10% or something like that. These derivative hedges are going to fluctuate in value enormously. I went in and I looked at all of their, just purely from operations, just their operating income and their operating earnings. And I still get the same numbers you do, a price to earnings of about 3.5, 4.5, somewhere there. And over time, a company with sticky assets under management, sticky customers. So again, very few people are ever going to surrender annuity. Pretty much the money is going to stay at Jackson Financial until they pass away and it goes to their descendants. Or they draw it down every month as they're getting payouts from it. But this is very, very sticky clients. So as long as they manage their book of hedges well, at some point it should trade up to a price to earnings of 15. I think it's just a matter of time till it gets there. And in the meantime, they're doing an enormous amount of share buyback. So they have a dividend. The dividend is growing because they're shrinking the float so quickly. They've actually been paying about the same amount of money out in the dividend, but it's just they're doing so much in share buybacks, the float is shrinking so fast. Because now they can do the share buybacks at 60 cents on the dollar for book value. I think it's a fantastic chance to get. I bet Jackson Financial will do a 5x in 5 years.
Yeah, I can see that happening. I think a PE of 15 is very reasonable. And look, I mean, based on where the EPS is looking to trade at the moment, how much do you think this company can grow? Will it be able to just grow steadily, or you think it can actually surprise people in terms of tailwinds for growth?
So they've been growing as the baby boomers retire, and they've been taking market share in the index-linked annuities. I think they probably will become the leader. So I think they're third or fourth place in that. I think they can be the first place in both markets in variable and index-linked annuities. They call them RILA, I think R something index-linked annuity. Anyway, I think they'll be in the first place in that. But it is a niche product, and annuities are not for everyone. So it's not like this company is going to be the next Berkshire Hathaway and grow to be $1 trillion of assets under management. I think there is an upper limit for size. What I find really interesting, though, is, and there was, I forget which classic ancient value investor did this, but there was one that was really big on life insurance companies, I think in the 90s when they were first getting rolled out. And there was a quirk in the accounting that as their liabilities were growing at a quick rate, because you start getting these monthly premiums in, but you're on the hook to pay out this enormous payment if somebody passes away. But, they're not, on average, they're not all passing away soon. So the accounting of it looked really bad. And there's the same thing as they get new assets under management, they have to keep on putting aside more and more money for loan loss reserves. I think what's going to be really fantastic about this company is when the baby boomers are, the pig is past the python, and their assets under management are actually shrinking. Because right now their payout policy is about 40 or 50%. I think when you get past the baby boomers retiring, their payout policy could be 150% because they're going to be drawing down their loan loss reserves as their assets under management kind of normalize and shrink. So I think this is a company that you could own for a very long time. The longer it stays mispriced, the more share buybacks they do. And then at the tail end of it, it'll have, if the price gets too high, they might move away from share buybacks and more toward the dividend. But at some point, this thing is just going to be a huge cash cow.
Yeah, I can see that happening. So you're suggesting as the clientele passes away without fully limiting their distributions or the distributions that Jackson pays them, they keep the capital that they've managed and they can do with it as they please. Their loan loss reserves don't need to be quite so large because they don't have as many customers on the books. So
right now, they're taking about half of their profits every year and just putting it in a great big fat piggy bank in case something goes bad. And then, once you get past the peak baby boomer retirement phase and the peak baby boomer, variable annuity buying phase, then the return of capital to shareholders can just go wild after that.
And do you think there'll be kind of opportunistic drawdowns in the stock based on the derivative book coming through in that kind of lumpy cash flow quarterly scenario? The algorithms, the street sees a bad quarter and kind of sells off the stock, and that'll be the time to really accumulate as we go.
Yeah. So the drawdowns they have had, and again, because they hedge against interest rates and they hedge against the stock market. So If interest rates rise, you'll see that there's a huge negative on their mark-to-market value of their derivative hedges, things like that. If the stock market rises too fast, it's the same thing. So that is definitely going to give a lot of opportunities. At some point, I think the market is going to have to figure out what this company is and just value them based on their operations as opposed to their GAAP metrics. But you've got about 60% of active investors are driven. So 60% of the dollars in the stock market that's active and not in ETFs, or is an active ETF, is done algorithmically, right? There's nobody listening to earnings calls and figuring out the company. They have 2,000 positions and nobody knows any of them. So that money might always get tricked by the GAAP accounting rules. But I think at some point, as Jackson Financial, as they continue their share buyback, as the price goes up enough over the years, at some point they'll get an investor base that understands them well enough that trick won't work anymore. It'll move toward a PE of 15 or so.
Yeah, it certainly makes a lot of sense. I would suggest it might even have a non-correlated source of alpha. And when you think about it, kind of moves in the opposite direction to the stock market or to bonds. And if we've got this thesis around the US debt situation being such that they really can't allow interest rates to rise at any great rate, which I would suggest we probably saw during this week, then I think Jackson on the hedge side of things should be reasonably safe. You're a derivative financial guy. How far out do they have to hedge these things? Do they have a long duration risk, or they just kind of 12-month and roll out the hedges?
So this is one of the problems, and I think I'll write their investor relations another email, because when I first started writing on my Substack, I reached out to a few investor relations teams, and I didn't get a strong positive response. But now in my email, I write that I have 4,000 retail investors that read my write-ups, and suddenly I'm starting to get interviews with CEOs and things like that. So there's a kind of an advantage to size. But one of the problems is I think their derivative hedges are a bit of a black box. There's a lot you can't know about it. So I'll do my best to get the CFO on the phone and see if I can try and quantify some of this. A lot of it you just have to, and this is where I think you get Warren Buffett coming in. He was a famous bank investor for a long time, but you just have to look at the character of the people involved. So I think with Jackson Financial, if you listen to the management team on earnings calls, I think you'll see how, this is an industry run by bean counters. They are extremely conservative. There's no creative accounting here. This is not flashy, Silicon Valley hustling going on. This is an extremely conservative and tightly run operation. And I think you have to use that to kind of substitute judgment about how the book of derivative hedges is working, because even if you read the 10K cover to cover, you're not going to get a huge amount of detail on how they're managing those hedges. And they might even fall back on, these are some proprietary trade secrets. But I'll send an email and see if I can get the CFO on a call and write about there is risk there. So I wouldn't put my entire portfolio in Jackson Financial, but I wouldn't be against making it a pretty large position either.
Well, you preempted my last question before we move on. What kind of weighting would one be comfortable with Jackson at the moment? I got it as about a 3, but I really want to load up on this.
Yeah, I mean, if you can find 10 good companies, I think if you can find 10 really good companies like Jackson Financial, I wouldn't be against putting a 10th in there. And because I think it is really one of the highest quality companies I've found, especially if you, and my background, I was a financial advisor for Merrill Lynch for a very brief while. And when you know the clients that do need annuities and just how infrequently they're surrendered, these are very sticky assets under management. This is a high quality business as long as they don't screw it up. And then, be the Warren Buffett, try and judge the character of the management team and say, hey, are these people that are going to screw it up? And I don't think they are.
You're not still on the payroll for the commission for Jackson Financial, mate?
No. And I didn't have my annuity license, so I always had to hand those kind of customers off to another team. I was happy to do it. If I ran into somebody who was really that risk averse, I was always happy to hand them off because they weren't very interested in any of my ideas anyway.
I could just imagine you pitching some deep degen value to some of these ultra conservative bean counters.
No. I mean, there was always some young 30-year-old engineers that wanted to hear about some hot ideas, but for the most part, that industry is dealing with 60-year-olds and putting them in balanced mutual funds.
Yeah. Now, speaking of the baby boomers, uncorrelated assets, accounting that's hard to understand, Finance of America. Where are we with Finance of America? I think I was talking to Uncle Rick last week. He knows a lot about reverse mortgages. He's been there, he's done it, and he's a fan of the idea. How are we going with Finance of America? Any news? Stock sold off a little bit. Doesn't seem to be any news as to why.
Yeah, no news. When it went from $5 a share to $30 a share, it got a lot of tourists. And then when it didn't do anything, those tourists have kind of slowly been closing out their position. I was really concerned about how the market would respond to the last earnings call, where there was some mark-to-market headwinds. But I think the next earnings call is going to have mark-to-market tailwinds. So I think the last couple times I've been asked about it, I said, the upcoming earnings call, I don't know, but the one after that should be good. And so that earnings call that I didn't know about, it came and went, and the price stayed mostly flat during that time. It was a risk, but it ended up not having the worst case outcome. I think the next earnings call should be the one where the first of those, and I've got a write-up on how their mortgage-backed securities work, but in order to get the cash to pay to the people who do the reverse mortgage, they take that home equity and they sell it as a mortgage-backed security. And the ones they did 5 years ago were at a lower interest rate. So there was a benefit to the company for that. Well, the first of those matured in April. So there's this residual income stream from these very underpriced MBS mortgage-backed securities they had issued. The first big chunk of cash should be coming in April, and that should be discussed on the upcoming earnings call. So I think this one could be a very exciting one, because suddenly the company is going to get, not just a mark-to-market book value, but actually a big slug of cash of some unknown amount.
That should respond. It should take a few people by surprise, I would imagine. Now, with the market cap, there's some shares out there that people don't know about. You mentioned last time that it's a larger market cap that might pass through a quick glance on a screener. So what's the current market cap structure of the company?
Yeah, so now Finance of America, when they went public, they had a lot of different business segments, a little bit like a little mini version of rocket companies. And then they kind of, in the downturn, refined themselves. They sold off all the business units that weren't reverse mortgages. And then they acquired, so they were the number one market leader in reverse mortgages, and they acquired the number two player. But because the valuations were so low, they did a stock-based acquisition of the number two player while their stock price was down. And they did it by giving them non-voting shares of an LLC. The number two player wasn't given public common stock because that would have diluted the current owners too much because the stock price was so low. So they have these, I think it's about 60% of the float because they paid more for the number two player just because their own stock price was so low. So I think about 60%, I could be wrong, 40 to 60% of the float is in this LLC that doesn't show up when you look at the company. So you have to, I think, and also, yeah, you get to 60 because they also did a convertible bond. So they had a debt maturity before they really got back into high gear, before they had 2 profitable quarters operationally. They had a debt maturity, and they refinanced that with a convertible bond. And so between the convertible bond and the LLC, I think what you see for market cap is only about 40% of the real market cap. So if it shows up as a $200 million company, just think of it as a $500 million company.
Yeah. Okay. Well, that makes sense. And in terms of their growth prospects, let's look out 3 to 5 years. What sort of revenues do you think this company can pull off? And let's compare it to
You're putting me on the spot. Let me pull up my spreadsheet.
He loves the spreadsheet.
I don't love them. There's only a handful of companies that I really modeled out, 5 years in the future. Because usually if something's so undervalued, it's either, going to go bankrupt or it's going to be 10x from here. So, and this is another one where I reached out to investor relations to try and talk to somebody. And I didn't start it with, hey, I have 4,000 subscribers. You should make the time for me. So we'll see if they respond differently now. But they have 3 sources of income. So when they sell one of these reverse mortgages, they pay themselves a mortgage origination fee. So that's kind of their operational income, is every time they sell a new policy, they pay themselves an origination fee. For a couple years with rising interest rates and Silicon Valley Investment Bank and all that, that number was operating at a loss, right? That was not enough to keep the lights on. But in the last 2 quarters, they've been operationally net income positive, which is fantastic. They also have something that I think they call it investment income. So there's 2 categories of these mortgages. In the US, we have this federal regulatory agencies, Fannie Mae, Freddie Mac, Ginnie Mae. So there's Ginnie Mae conforming mortgages and there's the non-conforming mortgages. they've sold, or they have about 20 billion of mortgage-backed securities for the Ginnie Mae conforming mortgages. And I don't know how the money moves around in that. I think they do capture a spread on that, but I don't know how much it is. And I think it might be floating on both ends so that the spread in between is fixed. But I don't know exactly how that pile of money works. I made some estimates because I can see on their quarterly statements how much they declared as income that quarter and what their $20 billion book is. So I think I estimated they make like a 1.5% spread on that as investing income. But I really need to talk to the management team and learn more about it. The one that I do know more about is the $7 billion they have in the non-conforming mortgages. So this is somebody that didn't qualify to be in the Ginnie Mae system. And the non-conforming mortgages, the person on that reverse mortgage, they get a floating rate mortgage. That's the floating rate mortgages. They have a benchmark index. I think it's called the 5/7 floating rate mortgage. No, that price is tied to a short-term interest rate. So that's going to be something like SOFR plus 3 or 4 or something like that. Now, again, to get the money to give to these people in their houses, they take that home equity that they're accumulating and they sell it as a mortgage-backed security. Mm-hmm. Mortgage-backed securities are 5-year fixed. So now you have this room where you have one end is fixed and one end is floating, and changes in interest rates can affect the spread that they're capturing. And this is what got the company, what really opened my eyes in the first place about them is that when the yield curve was inverted, which is a rare phenomenon, but we had it inverted the most that had ever been inverted for the longest that had ever been inverted. So this $7 billion book of non-conforming reverse mortgages, Finance of America Companies was accumulating in home equity based on the floating rate mortgage based on SOFR, which Jerome Powell had brought from 0 to 4.5. So that was, I think it was a SOFR plus 3. So they were capturing 7.8%. So the people who had a reverse mortgage were paying to Finance of America Companies 7.8% on their floating rate mortgage. But their legacy 5-year mortgage-backed securities that they had issued before interest rates rose, they were still at 3.16. You had a couple years where they were paying 3.16 and receiving $7.7 billion. And that was happening for a couple of years. It's less now, so the yield curve is not as inverted anymore, but it's also still not a normal yield curve. So they're still capturing an abnormal spread, it's just not huge. So again, the Finance of America companies, they've got 3 sources, 3 buckets of money. There's operationally when they pay themselves a commission. There's whatever is happening to the Ginnie Mae conforming mortgages, and that's a $20 billion book. I just have an estimate that that's about a 1.5% spread or something like that, or maybe even smaller. But I'd really have to talk to somebody there to figure out what's going on. And they didn't return, I think, about 4 or 5 emails. Because I guess if I start it with, hey, I'm the Unemployed Value Degen, they just throw that right in the trash.
Yeah, it might not attract so much attention. Invite them on a podcast, mate. I have a way with people, if you want. I'll see if I can open the door.
Well, it's like night and day. Once I hit 4,000 subscribers, suddenly I talked to the CEO of Abacus Life. I talked to the CEO of Alta Equipment Group. So suddenly I think I hit that threshold for subscribers where I get past the filter and they want to talk to me. So the future is very bright. And then the last bucket of money is the non-conforming mortgages, which they were nice enough to put in an investors slide deck, how that works and how they're capturing that spread.
All right. In terms of 3 to 5 year runway, what are we thinking in terms of revs, net income, and then a valuation on that net income to ultimately hit a price target?
Yeah. Now management guided a very, very low. They guided for operating income for 2025 of $26 million, which is very low. Because in the last quarter of 2024, I think they had net income of $22 million. So they were already earning as much last quarter as they say they're going to earn for all of 2025. So I don't know if they're under-promising to over-deliver, but that's just on the operations side. I think I've got them an estimate for, and I hope I did the spreadsheet conservatively because I always try to do it somewhat conservatively. I've got between the residuals and the investment income and the operational income, I've got a net income for 2026 of maybe somewhere between $200 and $250 million. And right now, that's a $500 million market cap company. So I think they're still incredibly cheap. And that's not counting the money that they've already earned from when interest rates were so inverted, the yield curve anyway.
That's incredible because that's basically 10x what analysts are guiding. Not that it has any decent kind of coverage, given it's such a small cap. What I'm thinking, last point on this particular co, Blackstone Tactical Opportunities owns 30%. How's that going to work in terms of them eventually exiting their position?
Yeah, I mean, a lot of funds have a rule that they can't have more than 5% in any position, which, especially when the Magnificent Seven is such a large percentage of the S&P 500, a lot of funds are saying, hey, we can't be market weight because Apple is so big, it's more than 5%. So we're underweight Apple and we're going to miss all our benchmarks. So yeah, I think if Finance of America company's stock price really had a big rally and it became more than 5% of their little fund, then they would probably have to sell some, and the selling pressure would bring down the price. But all that stuff would be temporary. And as long as they're consistently making money every quarter, although you're going to have the same mark-to-market effects that all these financial companies have, that there's going to be some mark-to-market gains and losses on their book value for things that happen each quarter. But if you look through that and look at their operational figures, I think buyers will come in.
Very interesting. Anything else that takes your fancy in terms of the US domestic banking / financial services / insurance sector? Because I'm really starting to go over this. I think it's a nice way to not be exposed so much to the commodity cycle and to have access to an ever more closed off US market.
Yeah, so I learned about this company. It's called Abacus Life. And one of my subscribers said, hey, when I'm at the gym, I see these Finance of America company advertisements on the TV all the time when I'm at the gym. But the ad that's always on at the same time with it is called Abacus Life. Are they interesting? So I looked it up and they were very interesting. Abacus Life is and this is a quirk of the US legal system. So this is not true in Canada and a lot of other places. But in the US, you own your life insurance policy as an asset. Right, and as opposed to in some countries, you would be stuck negotiating with the life insurance company the same way you have to negotiate with Jackson Financial to surrender an annuity. You'd be stuck just negotiating with the life insurance company in most countries. But in the U.S., it's a Supreme Court ruling from I think 100 years ago. You own it as an asset; that is yours. And what that means is you can sell it. So there is a small handful of companies, and most of them are private. And this one was private until a couple of years ago. They've been in business over 20 years, and the three founders still own a big chunk of the shares. But this is the first public one it's called a life insurance settlement company. So rather than trying to surrender your life insurance policy to get a small payout from your life insurance company, this is selling your life insurance policy to a third party. They'll make a market in your life insurance policy. And typically, the numbers right now are, on average, they pay about 7 times what your life insurance company will offer you in a settlement. It's just an outrageous, markup there compared to what the life insurance company will offer you. So this is the difference when you go to the life insurance company and say, hey, how much is this policy worth that I've been paying you for the last 30 years? And I say, oh, well, we'll give you, $50,000 for it. You go to Abacus Life and they say, oh, we'll give you $350,000 for it. But it's
So you start to ask yourself how much the original underwriter's making off this thing.
Oh yeah, well, I mean, life insurance policy has a large upfront commission for the salespeople, but it's also not an outrageous ripoff because you look at the life insurance companies and their profit margins aren't anything abnormal either. It's not like the life insurance companies are making money hand over fist, but the way that those policies are surrendered also so this is a market that's really unknown. I think most people don't even know that this exists as an option. So they're marketing. A huge part of it is just spreading awareness. In the US, 90% of life insurance policies never pay out because they're either surrendered or people don't even know you can surrender them and they'll just stop making payments. And that's the worst possible path. Because what happens is people will get a whole life insurance policy when they're in their 30s. So they say, okay, I've got a wife, I've got a mortgage, I've got several kids. If something happens to me, I want the house to be paid off and the kids to go to college. So they'll take out $1 million life insurance policy in their 30s. Well, then they retire and they're not working. Their income is less. Their kids have graduated college and the house is paid off. And they're looking at their bills and they say, why am I still paying for this life insurance policy? Because I have a 401k. I own my house free and clear. It's been a couple generations now in the US since people were genuinely afraid of, will I be able to pay for a funeral, or will I have a pauper's funeral in a pine box? I mean, people aren't, I mean, when I was a kid, you would see commercials on television for insurance policies you could take out to cover the cost of a funeral. So, prepay your funeral. But the people are so wealthy now, and they're also just not afraid of a pauper's funeral, right? It's not a dignity-based culture anymore. People they look at this life insurance policy when they're in their late 60s, early 70s and say, why do I need this thing? Why am I still paying them every month when now my kids are grown up? They have houses of their own. They have families of their own. About half of the baby boomers don't really believe in inheritance. They said, I paid for the kids' college. They're on their own, which, that's their prerogative. So the number of people who could take their life insurance policy and monetize it, I think, is a huge demographic. And the real battle is just nobody knows about it. So I have statistics on the whole market. In the whole market, so last year, Abacus Life bought 1,000 life insurance policies. And that's about 25%. So in the entire United States, out of 330 million people, 4,000 life insurance policies were purchased. I mean, the market, it hasn't been developed yet. It hasn't even grown. It is tiny.
Wow.
Right? All that has to happen is for some awareness to get out there. And these baby boomers with $75 trillion of assets, I think somewhere in the neighborhood of 5 to 8 trillion of that is their life insurance policies. So it's a huge chunk of assets. You're talking about 4,000 policies changing hands in a year. I mean, it's absolutely nothing. So there's so much room for the market to get built, and for there to be so much awareness, and for this thing to really, heat up. People going back to the sauna or the club and telling all their friends, hey, I just got $250,000 for my old life insurance policy. This is amazing. Next round of drinks is on me. That this is just a totally unknown marketplace. And so that's Abacus Life is pretty exciting. They've got about 25-26% market share. They're the only public company in the space. It's kind of the only way to participate in it. And they're growing so aggressively. And their margins are nice too. So the life insurance policy they buy for 7 times the surrender value, they just put a 20% markup, and then they can resell that to alternative asset managers who are willing to buy it. So there's kind of an unlimited amount of money willing to buy these things from Abacus Life if they can get the customers to sell them to them.
Yeah, that's super interesting. A couple of comments. You mentioned the growth. Last 3 years, revenue CAGR is 353%. I mean, this is insane, and we're still, as you mentioned, we haven't even started this party in terms of the growth runway that's ahead of them. The question I would have is that, what's the competition risk for this type of thing? Why wouldn't, let's say, another company in the space just start to open up a new branch of their existing division and start to compete for that market share? Or does it not really matter to Abacus?
So there are competitors. There's a handful of competitors. They're all private. I mean, this is just a really small niche market. There's always a possibility maybe a large player could get interested in it. Right now, Abacus Life does half of their business from their online, or from their advertisements, from their television commercials, and about half through the investment advisory channel. And even the investment advisors, a big chunk of them don't know about this. So, I mean, there's a huge room just to spread awareness. The average life insurance policy that they bought was something on the average is $1.7 million. So the only people who are kind of aware of this thing are the kind of most white glove, highest net worth financial advisors. This is just the fact that it even exists hasn't made its way all the way down to the Edward Joneses of the world. This is just a totally unknown thing for most of them. And I think a lot of them have clients that say, look, your kids are adults, they own their own houses. Do you really need this $250,000 life insurance policy anymore? I think part of the channel is going to be a lot like what Jackson Financial does, is there's going to be some sort of commission to the financial advisor who brings in the business. And right now that's about half of Abacus Life's source of these policies. They have competition, but they're 25% of the market. I mean, the competition could get more fierce, but right now it's in the stage where it's really just about spreading awareness. So who knows how the market's going to develop. They have 20 years of history in the marketplace. So if somebody tried to start a new company and compete with them, they'd have to overcome all the regulators and things like that. As far as their existing competitors, they're in the same market with the market share that they've been having. I mean, there is a risk that as the market develops, things change, but it looks like Abacus Life is kind of out in front and the one kind of pushing the spread of the awareness.
And let's comment, it's got a little bit of debt in terms of what I see on the balance sheet. How much of a concern is that? Or are you not concerned about it at all? Was it used for fueling this growth? How did it get to be in a position where the debt versus the EBITDA seems to be a little high?
Yeah. So they just raised that money this last year. So they could turn around and sell these life insurance policies pretty much as quickly as they wanted to. And I think last year their inventory turned over 4 times, give or take. So they, buy a life insurance policy, make a 20% markup, buy a life insurance policy, make a 20% markup 4 times in a year with the same capital. But what they want to do is hold the best life insurance policy. So they have 20 years worth of data on longevity. They want to hold their best life insurance policies on their books. Because these life insurance policies, yes, you have to pay the monthly premium to the life insurance company, but they have a positive theta. So they become more valuable over time. So this is going to be an appreciating asset. And they want to keep it on the books longer. They raised that money for debt so they could go from having 4 inventory turnovers a year down to 2 inventory turnovers a year and try and hold some of their best life insurance policies as long as they can.
That makes an awful lot of sense. Okay. And this is a fairly small cap company, your specialty. What's the chances of a heartbreaking buyout for a 30 to 50% premium?
So the 3 founders of the company and the current CEO was actually given a huge chunk of shares by those 3 founders. So now the 4 of them together, they're in the driver's seat. I think they don't have a super majority of voting stock, but they have, I think between the 4 of them, they have 30 or 40%. So I think they can pretty successfully, they're going to grow the company to the size they want to grow it to before they entertain any take private offers. And then one of their other main investors also has the same attitudes. They told me the name of the family office that's also, between the 3 founders, the CEO, and a family office, they have enough that's over 50%. There's no risk of going private unless they want it to. And right now, why would you take anything private that's growing 50% a year?
Okay. Satisfied? All right, mate. We've made it through 45 minutes without mentioning Trump, tariffs, geopolitical shenanigans. Now we can take a deep breath and we can let the macro monster loose. You wrote a great article, which was controversial, I don't know why, about the tariffs. And it's a very well-balanced, nuanced take. Check it out in Steve's Substack, guys, which of course will be listed in the description. My take is I looked over my portfolio, made a few little changes here and there, but nothing really, to be honest. I own land inside the US with royalties, and I own even more of these financial companies, which we've spoken about today. I actually, with this split, I'm actually quite happy being domestically positioned inside the US with companies that depend more or less on the domestic market that don't have to worry about importing or exporting. What do you want to talk about in terms of the news? Is there anything really groundbreaking that would make you change a thesis or that would make you make major shifts in your portfolio construction?
Well, I'd love to talk about tariffs because I have a graduate degree in economics. I mean, if there was ever a time to talk about it, now's the time. But I think some of the
time has come, my friend. The time has come. Let it loose. Embrace it. I love it.
I think some of the most important things are being lost under the radar because everybody's talking about tariffs too much. So there's 2 things that happened in the last couple of days that most people did not see or register or take the time to look into. One is that we have the US federal government budget deficit for March. So it's April now, so we just got March. That's the first full month when Elon Musk's Doge team was working.
Oh.
Let me see if I can share this.
Share it, mate. So did we save any money, or are government still spending more than they collect?
Check this out. So they're still spending more than they collect, but this is the lowest March budget deficit since before COVID. So look at the drop off from March from 2024 to 2025.
Okay.
And Doge is working. And that's not what is being spoken about in the popular press and the news media. All the popular press is like, oh, it's peanuts. It's not adding up to much. Elon Musk is destroying Tesla and he's a bad person and we don't like him. But it looks like things are this is the first full month that Doge is operational and the deficit has shrunk year over year. So that's just for March. And we'll see if this continues. If April is, sometimes it's just timing. Sometimes there's federal payments and it was March one year and then next year it's in April. So we'll see if this continues in the months ahead. But this is the first full month that Elon Musk's Doge was working, and something is happening. And that's, nobody's talking about that because of tariffs, and also because I think the financial news wouldn't paint this administration in a positive light at all. And then the other thing that's happening, so Trump came out that on his border security, step one was, aggressively and violently deporting, active criminal gang members. And step two is encouraging people to self-deport. And there was an old law on the books that Trump is reactivating, which allows him to fine people who are here illegally it's $998 a day, retroactively up to 5 years. So if you've been here illegally and I live in Tampa, there's a lot of people like this. Some of them are my neighbors and they're very nice people. And I don't want to comment on whether I think this law is a good thing, just the economic consequences of it. So if you've been here illegally, maybe you had some anchor kids, maybe your kids are American citizens, but you don't have the right to be here. And then you were able to get a driver's license from New York or California because they've been giving driver's license to illegal immigrants. And then you're able to get a house with a mortgage. Well, you can be fined now $1,000 a day for the last 5 years. And as you get deported, the government will seize your assets. And I think this could have a huge impact on the housing market. I think that's enough of a financial threat. And that threat goes away if you self-deport. So if you have, built up some home equity of $300,000, $400,000 since you've been here 20 years, there's a strong incentive to go to a government website, deport yourself, and then not give up all your assets, and then put your house for sale and take your $300,000 back with you to Colombia or to Peru or to Mexico or somewhere like that. So a program that strong actually could move the needle in the U.S. housing market. I had been looking at home builders. I had been looking at land banks. But and we don't really know how many illegal immigrants are in this country. There's anybody who thinks they know, it doesn't know. I mean, I have my economics degree. I've been at conferences. I've met with some of the researchers that cover this professionally, and they will admit it could be anywhere between 10 and 30 million, and nobody knows. But if you're talking about 10 million people, voluntarily leaving the U.S., that would have a huge impact on rents. It would have a huge impact on the housing market, and it would have a huge impact on blue-collar wages. And it just depends on the speed at which this news will get around, that the government can seize all of your assets up to 5 years worth of $998 a day if they deport you. So that is a very strong, and this law was on the books, I think, from the 1990s. Trump is just reactivating it, but that is a pretty big game changer. And so I was basing my inflation protection portfolio off of what worked in the 1970s, and that was oil, land, and gold. But the U.S. housing market and U.S. real estate, if you lose 10 million people and you have a bunch of houses seized and put on the market for sale, that could do a lot of things to property prices.
Okay, it certainly could, but let's take a deep breath here. What do you think the chances of realistically implementing something as big as that? I mean, the government resources, they're trying to downsize the government. Are they really going to want to push, the political backflow or backlash from this will obviously be quite strong. So how seriously would they really try and push? Do they even have the resources for this type of thing? Who's going to want to sign up for the immigration department to come and seize these houses and try and resell them?
Yeah, well, I think just the chance that it's possible might be enough for people to. So that was I think what Trump said however many months ago is, or might have been the interview with Joe Rogan that Trump was on, is that there's about 1 million illegal immigrants that are hardened criminals that have either a criminal record from their own country or in the United States. And
Sure.
that is going to be an actual, rounding up and putting them on airplanes and putting them in handcuffs. But there's another 10, 15 million people that you're just going to change the legal system enough to make it uncomfortable for them to be here until they go away on their own. So this is less about probably how many houses are going to get seized than more about how many people will voluntarily turn themselves in and say, hey, I was supposed to show up to court 5 years ago for my asylum status, and instead I got a job and bought a house, and I'd like to go ahead and sell that house now and fly back to Colombia.
Yeah. I guess that's a non-zero chance, but I'd probably take the other side of that. That sounds pretty out of the deal to me. I know many of the people whom you mentioned who would qualify for this type of situation. And I think they'll say, I'm not going back to where I came from. Drag me out of my house, basically.
Yeah, I mean, I think it depends on how much home equity. I mean, it also depends on which country they came from. And you don't have to actually go back to the country you came from. So I do know somebody who, even before this rule change came out, they moved out of the US just because of the new climate. I think it could have an impact. I'm not saying it's going to get all 10 or 15 million people out of the country. But if you have, $250,000 of home equity, you say, hey, should I just sell the house, move back to Belize or Honduras or somewhere like that for 6 months while I figure out what the next step is? I think some people might do that.
Yeah, that's potentially could be good for some of the real estate brokers. I don't see this. Let's talk about the land holdings, and I don't think this really applies to land that, let's say, the St. Joe company owns. Am I correct? Those guys are they're kind of at the other echelon of society.
Yeah, and they're also targeting baby boomers to retire in Florida. So St. Joe is definitely more high-end baby boomer, $75 trillion demographic. But, blue-collar working class neighborhoods, I think, could really have an effect. So some of your more budget home builders, I think, could be impacted.
I don't play in that space. I like my land sparse and fairly vacant, Stephen, with royalties attached. So oil, gold, you mentioned. What's going to happen in terms of US oil production? Is the export profile going to change? And the idea is that this is going to be domestically consumed. The refineries all seem to be in the US, and Canada doesn't really have any refineries. How should I look at this as a Texas landowner in this type of a scenario? I look and think, well, tariffs, generally speaking, are inflationary, but I don't know anything about economics, so maybe you'll correct me there. At the end of the day, oil goes higher, gold goes higher, royalties take a clip without having their expenses commensurately increase.
Yeah.
Am I wrong? What's happening?
Well, a lot of energy is exempt from the tariff. So a lot of countries say that they want cheap electricity, and so they're not putting tariffs on just basic energy. You still have the U.S. ramping up natural gas exports, and you've got the natural gas price, from $2 to $4 now, and a much more stable position for it to be in. I'm not sure why the oil price is as low as it is, because we've been in supply destruction mode for a while.
But
You've
don't
had
you
a
know
lot
that
of.
OPEC's going to release another 1,000,000 barrels, Stephen?
I mean, I've heard rumors that they can't, or that they can't cheaply. They're already at the point where they're pumping salt water into guar to try and extract more oil out of it. There's just an enormous treadmill to climb to replace the decline of these wells. I think one of the things that's happening is just and I saw this from some of the shipping companies I looked at, as far as how much more efficient the newer. I mean, you got to take your hat off to engineers. The fuel efficiency of the different types of engines that have been designed in the last 20 years are pretty incredible. I think that might be what's driving a lot of this, is that things are getting moved around on a much more efficient engines generally. But I don't think you can stay in supply destruction range forever. I just don't know when it's going to turn. I mean, $60 a barrel, there's just a lot of, and we've already had for the last 2 years. So the Permian is the oiliest of the shale basins in the U.S. Well, the other 5 or 6 shale basins in the U.S., their activity has fallen off a cliff because they need higher prices, either natural gas or oil, to be profitable. So the Permian's been flat, but the other 5 or 6 basins have just, productivity's crashed. That all can come back online, but it all comes back online at $80 oil, which we're not at. There was an article about, so output decreases because of mergers and acquisitions, because the acquiring company, they want to take 5 years worth of inventory and turn it into 20 years. So they're going to drill it, half or a fourth of the speed. And then there are still, so there are a lot of doomers saying that we've hit peak Permian and all that stuff. And that things are becoming, cost of extraction is getting so expensive. But there's new technologies coming out all the time. So I forget which company it is, but it was one of the majors is doing what they call triple fracking. So by fracking 3 wells at the same time, you're essentially using the same, you're using the same water and the same pressure and the same sand, but because you're doing it to 2 or 3 or 4 wells at the same time, you're saving a huge chunk of cost. You're getting it done 25% faster, and so that alone is saving about 12 or 15% of the cost of fracking a new well. So you see, just everywhere you look, there's all sorts of cost-saving measures that technology is still marching along in the Permian. So I think it's dangerous to listen to the doomers that think, we've hit peak Permian and things are going to be bad from here. I think output might fall because it chooses to fall because of the acquisitions, not because it's some geological certainty. And that just as these technologies keep getting better and better, tier 2 becomes as profitable as tier 1 used to be. And as soon as we get to the point that tier 3 is workable and viable, the further you get out from tier 1, there's just so much more of it. I mean, there's enough tier 3 shale to last us 150 years if we improve the technology well enough to make it profitable. And I think you're going to see a lot of those cost-saving measures happen. So they've done horseshoe wells, they've done 3-mile laterals, now they're doing triple fracking, and then there's refracking. There's all sorts of. I wouldn't bet against innovation, so I'd be very worried for the doomers. But I think, I don't think we can stay in supply disruption prices forever. I think the oil price is going to snap back from 60 to 80 or 90 at some point. And when it does, I think you'll see people that thought that the Permian couldn't produce anymore, or that the U.S. couldn't produce anymore. I mean, the people that think that the U.S. can't produce anymore, there's already another 5 shale basins that production's dropped off a cliff and can easily be turned back on. But even just doomers in the Permian, I wouldn't bet against innovation.
No, that's certainly Doomberg's whole argument, and it makes a lot of sense. The question is always around technological innovation, deflation versus economics to make some of that less friendly geology work. And this is where I just think having like an option, a call option on the future without that theta decay makes a lot of sense from the way that I look at things. In terms of the water cut with all of these innovations, I don't see, if you're using fracking, I don't see any way that you magically make the water cut reduce over time. And it's a problem. The produced water needs to be dealt with somehow. To me, I look back at some of the water tariff and compounded growth, and it reinforces the idea that actually it is a problem and it's going to become more and more expensive. Do you have any comments in terms of water generally? It doesn't have to apply to the Permian, but it's kind of like this thesis where everyone gets it, but it's extremely difficult to play. And that's where I've looked at some of the water handling companies or the transport, especially now with data centers becoming topics.
Yeah, so there's definitely cooling needs for the data centers, and there's water needs for the fracking. But the triple fracking technology that's come out reuses the water, so you're using the same amount of water for 3 wells that you used to use for 1 well. So that's an enormous water savings. And this gets back to that William Stanley Jevons' the coal question. As things become more expensive, people figure out more clever ways to make a better use of it. So I think that water is going to be valuable, and I'm not going to try and evangelize you out of the Church of Murray Stahl. I think he's a brilliant guy. And hats off to anybody who wants to invest alongside him in his strategy, and I think he's going to be right. But I don't think it's going to be anywhere near you can't extrapolate this stuff linearly, because it never goes linearly. I think that's the big takeaway from William Stanley Jevons, is that we figure out how to make better use of this stuff as it gets more expensive.
Yeah, absolutely. But even in terms of agriculture and municipal uses for water, and you guys in the US, you just don't have that. It just seems to be a very peculiar situation. You don't have that really good way of being able to invest, unless I'm missing something.
Yeah, so, and agriculture generally. So there's just not a lot of amazing ways to invest in public agriculture and public water. So it's maybe private equity, instead of trying to roll up more air conditioning HVAC companies, they should be figuring out how to make some of these companies public that allow people to invest in them. It's amazing. I think it's 10% of all private equity activity is for HVAC companies. And now the big joke is, you realize all the machinery is built in China and now has 125% tariff on it. So anyway, we can't live without our air conditioners here in Florida. We absolutely need that.
Absolutely.
Yeah. I mean, it's water is one of those things that, and this is, I think I was in high school when we were invading Kuwait, and we could have 20, 30 years ago done nuclear energy and desalinization plants, kick ourselves every time because we didn't. So There's that African proverb, the best time to plant a tree was 20 years ago, and the second best time to plant a tree is today. The United States has a lot of good water resources if you're managing them well. There's not a lot of very easy public opportunities to invest there. And also, when there are public opportunities to invest in water, there are a lot of themed ETFs and themed mutual funds that it's because it makes people feel good to buy, the prices get bid out of control. So I don't think I'd find it to be particularly undervalued, because especially when I was a financial advisor, the retail investors just love this stuff. You get some 65-year-old retiree. He wants to put 5 or 10% of his portfolio in water because he wants to sleep well at night, thinking that he's getting paid a dividend in his retirement, but he's also, providing potable drinking water in sub-Saharan Africa. So he gets to sleep, warm and comfy at night, feeling good about himself, as opposed to buying dirty things like tobacco and coal and stuff like that.
Okay. Well, I've got to make a joke. I can't let it pass. I was fairly rebellious in high school, Stephen, but I didn't go so far as to invade Kuwait. I don't know. I thought your industrious spirit in high school.
Oh, well.
Gold, it's all the rage. It's doing its thing. We're pretty happy. In terms of gold, the US dollar, emerging markets, what does the economics professor have for us in terms of the way the world is heading? It's all basically playing out like a Jim Rickards novel. Well, not novel, a book, I would say, up to this point.
Yeah, no, I mean, the move in gold has been fast and aggressive, and central banks are buying, and portfolio managers and retail investors haven't been buying. It's I think the end game, not just the central banks want the stuff, but now that we're in the world where stocks and bonds are positively correlated, the only things that are going to be negatively correlated are maybe energy and gold. So portfolio managers, if you want to have 5, 10, 20% of your portfolio on something negatively correlated, they're going to have to look at energy and gold. And that hasn't happened yet. That's going to be a 10-year process. As first it starts at Goldman Sachs, and then it finally ends up at Edward Jones, with 10 years in between. And then finally, when it gets dispersed to, the middle class, that's when the trade is over and it collapses. So yeah, in a lot of ways, I think this is just the beginning of something that's going to last for a decade. In the short term, the move has been so aggressive, I'm more and more concerned about a pullback, because the demand for money is always driven up by uncertainty. And we've had a huge spike of uncertainty recently. So if we had some more certainty, if the tariff situation resolves itself before whatever, President Trump decides to make his next big push to add uncertainty to the markets, but if you get some uncertainty taken out of the system, that could also take away from the gold price in the short term. I mean, in the long term, China is buying, the central banks of the world are buying. That conversation that there was going to be some basket of currencies for the BRICS countries because they all have different endowments of natural resources. In Karl Menger's The Origins of Money, I think in the 1860s, he argued that the most marketable commodity is going to take over the basket. And so that a basket of commodities in the end just means you're going to have a gold-based currency. And I think that's what we see, is that that whole central banks of the BRICS countries are all buying gold, because at the end of the day, it's a network good. The most marketable commodity wins, and gold beats out all the other commodities for money.
Tariffs, where are we at? It was kind of the whole world got blanket tariffs. China got special treatment. And then we had a tweet that says, just kidding, we'll postpone 90 days except for China. How does one invest in this type of environment? Professor of economics, is it a case that you're pretty much the status quo with the exception of China? Or should we all be worried?
Yeah, well, I think the big thing happening in the world is we went from a world where the US is the only superpower to now China and the US are pure rivals. And everything has to be rethought along those lines. And I've got, so two things, well, there's like 3 points I want to say about tariffs. One is, so much of trade protectionism is done in ways that are either not tariffs or, not even on the books, but just the selective enforcement of the books. And then they're mixed in with some legitimate, agricultural quality concerns, but then there's taken too far.
The non-tariff trade barriers.
Yeah, and some of the non-tariff trade barriers are more easily quantifiable, and some of them aren't. So I use the example in my write-up of Canada's dairy import protection against the U.S. But here in Florida, so we were trying to export our oranges from Florida, and when it comes to a place like China, their rule for importing citrus was that you had to have optical visual inspection, which required cutting the orange in half to check the inside. And you've asked you what percentage of oranges have to be inspected that way. It's 100%. So if you were going to try and export oranges to China, they say, okay, well, when it gets to customs, we have to cut every orange in half and look inside of it. So what is the effective tariff rate if that's the trade barrier? There is no number there. It doesn't make any sense, right? So in the case of Canada's trade protection against US dairy products, well, there's a quota for, and I have this, copied and pasted into my write-up, for how many tens of thousands of metric tons there's a quota. And you could take that quota and say, oh, well, that's equivalent to a 20% tariff. But the problem with that is then that quota is given to an oligopoly, which has some sort of, under the table, wink, wink, nudge, nudge, know what I mean, with the government of Canada to not buy the full quota. So if that quota was given to the grocery stores, they would buy a bunch of US ice cream. But it's not given to the grocery stores, it's given to the dairy processors who have some sort of agreement with the government of Canada not to implement it fully. And so there's a quota, and then Canada only imports about 27% of their quota. And so it's not just that it's not a tariff, it's a non-tariff barrier that you could maybe estimate. It's that a lot of times the facts on the ground are totally different from the facts in reality. So what's the effective tariff from Canada on the US for dairy? It's a totally unknowable number, right? So the World Bank has some numbers they try to put out there, and I think you should look at them because the numbers tell a story. It might be directionally correct, but the idea that you can quantify every good in the world in situations where, oh, hey, guess what? We gave the quota to an oligopoly and they agreed not to buy it, or we have to cut open every orange, or take your pick, right? There's every single product for every country in the world. If you try to put that into a linear system of equations, it would take a computer something like 4 quadrillion years to calculate it, because exponentially it gets big. So anyway, this stuff is totally unknowable. But I'll just share, let's see. This is the World Bank's estimation of tariffs and non-tariff barriers for OECD countries. And I just putting out there, these numbers are all going to be wrong, but there are some jerks who live in Switzerland and make $200,000 a year working for the World Bank that put these data together. Most of them try to do an honest job, but this is still going to be a lot of wrong stuff in there. And you see, out of the G20 countries, the United States has the lowest protectionism out of any country. And there's been so much in the news media about how free trade is wonderful and how dare Trump try and put tariffs on their allies. It's like, geez, some allies, thank you guys very much for all of the tariffs that you put on our goods. So I think this is where we get to the world where, this is what the world looked like when there was the world's only superpower. And they didn't mind, being in the nightclub and making it rain and just sending all those singles out to everybody and just letting the rest of the world live on this kind of largesse. But if we need to live in a world where the West kind of has to pool resources to counter China in any reasonable way, what this is going to look like is the United States having a higher effective tariff rate on the rest of their allies. So I think you're going to see, the only sensible policy in a multipolar world, unless you just want to hand the world over to China. Maybe they deserve a century in the driver's seat, and maybe they'll be kinder than the US was. Maybe not. But if you don't want, then you probably have to see a world where the US is, bringing in about 10 or 15% in tariffs, and all of their allies are not charging the US. And I think that's the outcome that Trump's trying to accomplish by saying, hey, you get 50% tariffs, and you get 60% tariffs, and you get 70% tariffs. All of those countries can get down to 10% as long as they give Trump concessions. And those concessions, some of them are going to be, well, you have to match our tariffs on China because you're our ally. China has stolen our intellectual property, and they're, banning the exports of rare earth minerals. China's not a friendly country, right? We're not at a state of war. It's not even a cold war. It's a cold rivalry, right? And so there's going to be sort of a realignment of allies in this, where the US is going to go to, by the way, I think this should be a bipartisan issue, but it's getting caught up in the left-right paradigm where you have countries like Canada, where I think Chrystia Freeland said, okay, we need to get nuclear weapons from the UK to defend Canada against the US. I mean, this is crazy people. And I think what you find is that the left parties all over the West, I'll stop sharing this for a moment. So, and I don't want to get too partisan, but we have a congressman in the U.S. His name is Eric Swalwell, and Eric Swalwell, he was on the Intelligence Committee. The other congressman got a briefing saying, "Hey, there's a concern about this guy in the Intelligence Committee because he was the victim of a Chinese honeypot." Right.
Yeah,
So Eric
I remember that.
Swalwell had a girlfriend named Feng Feng. So all the headlines were Feng Feng Bang Bang, things like that. But what's shocking about this story is if you look back how early into this politician's career that he was a suitable target for a Chinese honeypot. They were going after him when he was like a local city commissioner in a podunk town in the middle of nowhere. So the extent to which the Chinese are willing to spend enormous amounts of resources subverting Western democracies is pretty overwhelming. So I think, and I think you see this in the animosity towards this rebalancing of tariff trade. Because, Japan said, well, this is a legitimate concern. We'll come to the negotiating table immediately. Vietnam said, this is a legitimate concern. We'll come to the negotiating table immediately. Canada said, we're going to get nukes. Like, this is crazy stuff. So I think...
I never liked that place.
Yeah. So I think the extent to which Western countries have, at least, I think more specifically the left-wing party, but even look on our Senate Majority Leader, Mitch McConnell, right? His wife is Chinese and he turned his Senate job into becoming worth $80 million. So how is that going to work? So
yeah,
to a certain extent,
I'm rethinking my stance on this public service career. I mean, if you're going to there's honeypots on the table, there's 80 mil. I mean, maybe I'll just give up this podcasting thing and just become a politician.
Go into politics and get a Chinese wife and you'll be taken care of, right? It's a great plan. But I think the West kind of needs a certain amount of McCarthyism because the extent to which the Chinese have infiltrated politics, and again, not trying to get too much right versus left, but just read the Eric Swalwell Feng Feng story and just look at how early in his career they went after him. How, and when you have this group of people that are compromised, well, then do they get into the, party national committees? And do they choose, okay, well, when a vacancy opens up for higher office, who runs for it? The person that's in the pocket. And to what extent so we've got a problem with Canada, that Canada doesn't cooperate with our criminal investigations for organized crime syndicates because the Chinese organized crime syndicates are operating in Canada with real estate scams. And TD Bank was just fined $3 billion for laundering money for Chinese crime syndicates. And Canada's giving us zero cooperation for prosecuting these people. Well, to what extent are all Western countries infiltrated by the Chinese party? Anyway, but back to tariffs. The world where the US has the lowest level of tariffs in the West is probably going to become flipped. Because if there's going to be any countering of China at all, we kind of have to pool resources. And I think that's what Trump is trying to accomplish. And all this anger and hatred comes out of the woodwork. And I think a lot of that is, straight out of China, who doesn't want that to happen.
Yeah, or just Trump derangement syndrome. It's a pandemic. Forget COVID. Trump derangement syndrome is just a pandemic. I can't go anywhere in public and you have the mainstream legacy media here, and it's not even reporting. It's just slander. And I see Scott Bessent and I think Peter Navarro on CNBC, and I'm thinking to myself, the way you just look at the way the interviewer behaves during those interviews. It's not the stuff of news. It's incredible.
Yeah, well, I mean, they've destroyed their brands. People have gone to alternative media sources now. So I think the viewership now of all the legacy media combined is just a fraction of a Joe Rogan podcast.
Yeah,
and they did that to themselves. Right? The ball was in their court and it was theirs to lose, and they can't blame anybody but themselves for it.
Yeah, it won't stop them from doing so, though, my friend. So the dollar. We think that there was some Chinese-owned US treasuries sold off that made the bond yields go up, and that might have been the reason that Trumpy put a little pause on some of the tariffs. How big of an issue is this rising interest rates, and can the Chinese use their treasuries as a weapon by dumping them onto the market? Or can the US just pull off what the Europeans did with Russians and just simply confiscate the assets? that might escalate things even more, just a
Yeah, I
touch.
mean it's not off the table.
Jesus
Because,
Christ.
well, you have Chinese sponsored farmland acquisitions near U.S. military bases in the country. So there are Chinese assets that are on the table to seize. And you have the Panama Canal, where there was a deal in the works to have BlackRock acquire it from the Chinese company that owned the ports surrounding the Panama Canal. And then the Chinese government wants to put that deal on hold and push back against all this stuff. People are compensated appropriately, or whether stuff gets seized, who knows? But this is a multipolar world. This is a bifurcated world, and the U.S. is going to plant its flag on our hemisphere, right, on North and South America, and go Monroe Doctrine to the extreme. And China, we had started a pivot to Asia before the Biden administration, but the Biden administration in the Ukraine war was an enormous delay to the pivot to Asia that the United States was trying to impose. If you get into the real politics of the difference between a unipolar world and a multipolar world, in a multipolar world, the first priority of the regional power is you have to completely control your region. So that would mean China is going to be doing, much, much stronger efforts to have more influence on South Korea and Japan. So at any U.S. allied countries that are close to China, I think it's just a matter of erosion. If they're setting up honeypots against Eric Swalwell in California, what are they doing to South Korean politicians and things like that? So I would say, that's kind of the nature of the world right now in the multipolar world, is for the U.S. to focus on the Monroe Doctrine in North and South America, and for China to focus on, on solidifying their stranglehold on their region over there. So, probably South Korea and Japan could. I think you'll see that with the tariff negotiations. I think you'll see the U.S. be tougher on Europe, Canada, and Mexico than they will be on India and South Korea and Japan, because they need some support and some benefits to try and counteract China over there.
Okay. How do you see things playing out for those of us down under, Australia and New Zealand particularly?
Yeah, well, if you guys don't get your immigration under control, there's so many people from India and China that want to move there. You can't have that kind of immigration with a democracy, or the country just changes hands, right? But your politicians are pushing for those policies.
Mate, we are running the California 1980s playbook here.
Yeah.
I'm telling you right now. It's ridiculous. We're bringing the equivalent of the state of Tasmania in every year since whenever the borders opened up after COVID. So I don't know. Hey, give me some good news. I was hoping for some good news.
I mean, the good news is I think things are going to go pretty well in the economy. I think we're pretty far away from any sort of a financial crisis. Everybody's waiting for the next, big global financial crisis. But for that to happen, you have to have malinvestment caused by interest rates that were too low. And in this last, 15 years of zero interest rates, we didn't build anything in the U.S. So if you don't build anything, you can't have the malinvestment. I think the malinvestment from the zero interest rates is why the Chinese economy has been kind of struggling for the last few years. I think they're going through their Great Depression because they overbuilt apartment buildings. But as far as the United States is concerned, I think we're so far away from the next major financial crisis that things are looking pretty good. I think you're going to see some real economic growth, some nominal economic growth. I know Jamie Dimon was out there from JP Morgan saying things are bad. The last time he said, oh, there's going to be a hurricane, and then nothing happened. It's the nature of bankers to be focusing on risks. And I don't think that he has a balanced view of what's happening here. So I think, economic growth in the United States is going to be pretty booming. You're going to see huge productivity gains coming from artificial intelligence. There's a lot of people saying, oh, well, I don't see it affecting my life yet. But if you talk to somebody whose industry is being affected by artificial intelligence, it's revolutionary. Overnight, things are just, entire job descriptions are going away. There's going to be a lag for which new kinds of jobs are created because of that. But I know we're living in a period of enormous change, but also enormous productivity growth. But that's typically a good time to be in. I mean, if you look at, so the last period of massive productivity growth was the 90s with the personal computer revolution. So when you have personal computers come out, and then instead of having people whose job title was calculator and they would do math problems for a living, suddenly everybody has access to Microsoft Excel, and all of those people who had to use punch card systems and do math calculations all day, they all got retrained to do other jobs. Well, those periods where you have productivity increasing at a fast clip, those are fantastic times to be alive. Everybody looks on those as the good old days, right? So we're probably entering, a nice decade of enormous productivity, just fantastic times. It's never fun if your job description gets obsoleted. But there's going to be so many other opportunities out there. You just have to stay a little dynamic.
Okay, I think I know some accountants that might disagree with you with the job description obsolete type thing. They don't really care about their job. They tell me. Well, in that case, are we going to have this rerun of the 70s, mate? Because that's kind of been my inkling that we're going to have a new version of it'll be slightly different, but the 70s in terms of this persistent and volatile inflation for 10 years or so, given the dearth of capex, the monetary debasement as the main drivers, and now we've got this deglobalization fuel being added to our little geopolitical fire.
So I do still believe in the commodity super cycle, except in one area, and that's oil because of shale. And the shale can be turned on so fast that the 1970s, part of it was guns and butter, right? Part of it was money printing. Part of it was inflation because President Johnson said that we can have warfare and welfare. We can have the Vietnam War and we can have the Great Society. We can just print money and pay for it. But the other part of that was, OPEC's, driving up the oil price and us having a huge increase in energy costs. I think with the shale revolution, I think you can only get about, something like half of the 1970s. I think we're going to have another inflation spike, but we're not going to have the corresponding energy price shock that we had in the 1970s. So it's going to be like a diet version of the 1970s. And a diet version of the 1970s wouldn't be so bad because when you have costs rising because of energy prices, it's not entirely clear that the solution to that is to have 14% interest rates. I know history remembers Paul Volcker as he did the right thing. Well, maybe not, right? What we had to do was drill for oil again, and we did. The market cap of Schlumberger got equal to the market cap of Exxon. We had to drill so much oil so fast. Schlumberger's market cap went from being a tiny little oil service company to the same size as Exxon. Because the problem was we didn't drill for oil, and we needed to drill for oil, and we did drill for oil, but it took time. Higher interest rates doesn't fix that. No. So I think the next inflation spike is going to come when interest rates fall low enough for people to tap their home equity. Because with the house price increases from COVID, you've got 30-year-olds sitting on $250,000 of home equity. We have more home equity on a relative basis than has ever existed in U.S. history. But nobody's doing a home equity loan because the prices are too high. So if we ever see interest rates low enough for people to take out home equity loans, they're going to go out and spend that money and buy a Harley Davidson and a Winnebago, and people are going to go take that money out and spend it. So when that happens, inflation's going to come back. But before that, I don't think we can have an energy price shock the same way that we had in the 1970s, because now we're an energy exporter, we're not an energy importer. We can turn energy resources on much faster with fracking and with shale. So I think it's diet 1970s, where there will be an inflation spike coming out of the banking system from when they make loans again. But they have to make loans again, which means people have to apply for the loans, which means we have to have low interest rates to do that.
Yeah. But in order for that production to come online, I'm being long oil capex. Onshore versus offshore. Offshore has been hit hard over the last 12 to 18 months. What do you see in terms of the likelihood of a recovery in the offshore services space? We're all playing this for discount to floating steel value. What happens if we go bankrupt again before we get to the other side of this thing?
Yeah, I mean, Transocean is trading at a lower price than it was when their day rates were $200,000 a day lower. It's pretty amazing. And they have some amortizing debt, so they should be somewhat less levered than they were several years ago. And so right now, Transocean has a 2-year order book. So they're fully booked out for 2 years, aside from their cold stack rigs. Valaris and Noble only have 1 year. So I think we're in a little bit of uncertainty is kind of the enemy of capex. So this period of uncertainty, what's great about offshore is that's the best way for the US to get heavy oil. Shale oil is light oil, and our refineries are set up to mix some light oil with some heavy oil. Offshore is the best way for us to get heavy oil, and it comes in at a pretty low cost per barrel. So I think there's definitely a real I don't think offshore is obsolete. I don't think all those ships should get scrapped. I think the capex is slowed down because of the uncertainty. That's gonna, as soon as there's some price spike, and I'm surprised it's taken this long. And I think everybody that, if you have had any guests that talk about oil, they are also shocked at how low the price of oil is. But at some point, it's going to swing from supply destruction to demand destruction. And when that price gets high, then the orders are going to be out there for trying to book a drill ship. And then they're going to find out that there aren't that many drill ships and the price is going to be higher. But Transocean has a 2-year backlog. If I had to take a guess, are the day rates going to start increasing again at some point over the next 2 years? I would bet, yeah. That the need for heavy oil to blend with the light oil is too important. And also the marginal cost per barrel of being, $50 a gallon offshore versus, $70 a barrel onshore versus $50 offshore. It makes a lot of sense. It's just that one of the nice things about shale is you can bring it on a little at a time. And offshore, you have to have a huge upfront cost. That's really the difference, is that whether you want to do the big upfront cost or just do it a little bit at a time. Yeah, I'm still bullish the offshore theme. I'm shocked the prices got this low. Definitely feeling some pain from it. But maybe I'm intransigent and curmudgeonly, but I haven't changed the thesis. I don't think anything fundamental has changed other than the day rate increases slowed down for a bit and they'll be back again.
Yeah, makes sense. And if you are Valaris, maybe you've got a lighter order book ahead, but you've also got a much lighter balance sheet. What's the real risk in this thing as you look out today?
The equipment does all need to be maintained. If I had to choose, would I rather have a 1-year order book and a clean balance sheet, or a 2-year order book and indebted balance sheet? It might be a bit of a toss-up. 2 years is enough for me to have confidence that the prices are going to be back. Is Valaris going to have some pain in the near term if they can't fill their order book after this year is up? I think it's possible they could have some pain, and they have to maintain that equipment, and that maintenance is not cheap. But they could take out a little bit of debt to get from here to there. The thing that I still like Transocean better for is that they have the higher specification rigs. They've got the 8th gen and the 7th gen plus, and they have the harsh environment. But Valaris has the better balance sheet by a long stretch, and that's nice too. I don't think there's a bad company out of the top 3. Valaris, Noble, Transocean. I wouldn't try and argue against anybody buying any of them. I think they're all cheap and they're all great.
Well, thank you very much, my friend. Once again, I promise not to go over time and I break my promise. Is there anything else that you'd like to leave us with? I think this has been a really good session, mate. I've learned a lot. Hopefully the viewers have as well.
No, just everybody's talking about tariffs so much that the first full month of Elon Musk's Doge is out, and the deficit in March is the lowest since COVID. So real tangible results, and nobody's talking about it. And we'll have to see. So 1 month doesn't make a trend yet. So we'll have to see. Because sometimes federal expenditure is all just timing. So we'll have to see what April looks like and May, but it might have a really positive trend there.
Okay, well, we'll catch up and see what happens over the next month. Thank you very much for joining me here today, guys. Make sure you check the links in the description to check out Steve's work. It's fantastic work. Unemployed Value Degen on the Substacks. Take care, guys, and we'll be back with another episode shortly.